There's something peculiar happening in the world of high finance right now. While headlines trumpet record-breaking stock market gains and artificial intelligence promises to reshape our entire economy, a quieter story is unfolding behind closed doors. The wealthiest investors on the planet, the ones who've seen market cycles come and go like seasons, are making moves that tell a very different story than the one playing out on CNBC. They're building cash positions. They're trimming winners. They're stress-testing portfolios and asking uncomfortable questions about what happens when the music stops. And if you pay close enough attention to what they're doing, rather than what they're saying, you'll notice something striking. They're preparing for a storm. Now, before you think this is just another sky-is-falling prediction designed to get clicks and views, let me be clear about something. Markets have been climbing for 3 straight years, delivering double-digit returns that have made a lot of people a lot of money. The economy, by most traditional measures, looks resilient. Unemployment remains historically low. Corporate earnings, particularly in technology, have been nothing short of extraordinary. On the surface, everything looks fine. Better than fine, actually. But that's precisely what makes this moment so interesting. Because beneath that calm surface, there are warning signals flashing red. Signals that have appeared before every major market correction in modern history. And the millionaires, the institutional investors, the people who manage billions of dollars, they're not ignoring these signals. They're acting on them. Let's start with something called the Buffett indicator. Named after Warren Buffett himself, this metric compares the total value of all publicly traded stocks in America to the size of our entire economy, measured by gross domestic product. Buffett once called it probably the best single measure of where valuations stand at any given moment. Right now, as we move through early 2026, the Buffett indicator sits at approximately 223 to 230%, depending on the data source. Let me put that in perspective for you. That means the stock market is worth more than twice the size of the entire American economy. The last time this indicator approached 200% was in the year 2000, right before the dot-com bubble burst and wiped out trillions in wealth. Before that, it spiked during the late 1920s, just before the Great Depression. These aren't coincidences. When stock prices race far ahead of actual economic output, something has to give eventually. Buffett himself warned back in 2001 that if this ratio approaches 200%, you're playing with fire. Today we're not just at 200%. We've blown past it and kept climbing. But that's not the only alarm bell ringing. There's another metric that serious investors watch closely: the Shiller-Cape ratio, named after Nobel laureate Robert Shiller. This calculation looks at stock prices compared to average earnings over the past 10 years, adjusted for inflation. It smooths out the business cycle to give you a clearer picture of whether the market is cheap or expensive relative to what companies actually earn. The long-term average for this ratio, going back over a century, sits around 16 to 17. As of January 2026, it's hovering between 39 and 40. This is only the second time in over 150 years that this metric has crossed the 40 threshold. The last time it reached these levels was during the year 2000, at the peak of the dot-com bubble. Before that, you have to go all the way back to 1929. In both of those instances, the market subsequently crashed. Not gradually declined. Crashed. We're talking about drops of 50% or more that took years to recover from. Then, there's the forward price-to-earnings ratio for the S&P 500, currently sitting around 22 times estimated future earnings. This is elevated compared to both the 5-year average of about 20 and the 10-year average of roughly 18 to 19. What this suggests is that investors are paying a premium for expected corporate profits. According to recent data, the only other times when the market traded at similar forward valuations in recent decades were during the dot-com bubble and during the unusual conditions of the COVID pandemic, when near zero interest rates and massive government stimulus created artificial support for asset prices. Federal Reserve Chairman Jerome Powell even weighed in last September, warning that by many measures, equity prices are fairly highly valued. When the head of the Federal Reserve, the institution responsible for managing monetary policy and financial stability, publicly expresses concern about stock valuations, it's worth noting. Based on publicly available information, minutes from Federal Reserve meetings have shown officials commenting on stretched asset valuations, with concerns raised about the possibility of market corrections. These are the people with access to extensive data and analysis, and their caution carries weight. Here's what makes all of this particularly interesting. Market historians and economists have observed that major financial collapses of the last century have often followed similar patterns. While the specific circumstances differ, there are recurring themes that appeared before crashes in 1929, 1987, 2000, and 2008. Several of these warning signs are visible in early 2026. The first stage is excessive credit expansion. Debt levels balloon across the system. Right now, margin debt, the money investors borrow to buy stocks, while down from its peaks, remains at elevated levels when combined with other forms of leverage. But that's just what shows up in the headline numbers. Add in securities-based lending used by wealthy investors, the massive leverage embedded in options markets, and hidden derivatives exposure, and the true picture of systemic leverage becomes concerning. Corporate debt has swelled to over $10 trillion. Much of this borrowing, rather than funding productive investment in new factories or research, has been used for stock buybacks that artificially inflate share prices. Government debt has crossed $38 trillion as of January 2026, with interest payments now consuming over $1 trillion annually. When you look at total debt as a percentage of GDP across all sectors, household, corporate, and government combined, the levels stand near or above historical peaks. The second stage is extreme market concentration, when a tiny number of stocks account for a huge percentage of total market value. The system becomes fragile. Based on recent analysis, the 10 largest companies in the S&P 500 now represent roughly 40 to 45% of the index's total market value. Nearly half the market's value concentrated in just 10 names. Most of these are the so-called Magnificent Seven technology stocks, all riding high on the artificial intelligence boom. If anything happens to disrupt that narrative, if AI spending disappoints or if valuations come back to earth, the ripple effects could be substantial, because so much of the market's weight rests on these few companies. The third stage involves deteriorating liquidity. This is the market's oxygen supply. When credit tightens, when the Federal Reserve reduces its balance sheet, when lending standards become more strict, liquidity slowly drains from the system. The danger is that everyone assumes it will always be there until suddenly, when they need it most, it isn't. The fourth stage involves a divergence between smart money and retail investors. There's evidence that corporate executives and board members have been reducing their holdings at elevated rates. They're selling stock in their own companies, the businesses they know better than anyone. Meanwhile, retail investors, people investing through apps and retirement accounts, have continued feeding money into the market. This imbalance between insiders lightening up and regular investors adding exposure has historically been viewed as a warning sign, though it doesn't predict exact timing. The fifth and final stage is the trigger. No one can predict exactly what it will be or when it will arrive. It could be a geopolitical event. It could be a major company failure. It could be something in the derivatives market that cascades out of control. It could be a political crisis that undermines confidence. Based on historical patterns, when the first four stages are in place, the trigger has typically arrived within a 12 to 24-month window, though this is an observation of past cycles, not a prediction of future ones. So what are millionaires and institutional investors actually doing with this information? How are they positioning their portfolios when the warning lights are flashing? The most telling example comes from Warren Buffett himself. Over the past 2 years, Buffett has built Berkshire Hathaway's cash position to record levels. According to the most recent reports, Berkshire is holding somewhere between $340 and $380 billion in cash and short-term Treasury securities. That's more than double the previous peak and represents an unprecedented level of dry powder for the company. He's been a net seller of stocks, trimming major positions in companies like Apple and Bank of America. His Apple stake, which was once valued at close to $200 billion, has been cut down to around $60 billion. Not because Apple is a bad business, but because at certain valuations, even great companies become risky investments when priced for perfection. Buffett isn't running for the exits in panic. He's not predicting the end of the world. But his actions speak volumes. When one of the greatest investors in history builds a cash position this large, while markets are making new highs, it's worth paying attention. This pattern suggests he doesn't see compelling value in today's market prices, relative to the risk-free rate he can earn on Treasury securities. But it's not just Buffett. Research into how ultra-high net worth individuals approach investing reveals some consistent patterns that appear to be playing out currently. First, there's a trend toward prioritizing quality over momentum. Instead of chasing whatever stock has been going up lately, the focus appears to be shifting toward companies with strong fundamentals, solid balance sheets, consistent cash flow, and experienced management teams that have navigated volatility before. These wealthy investors understand something crucial. In good times, almost any stock can look like a winner. But when markets turn, only quality companies survive and eventually thrive. Weak businesses, the ones built more on hype than substance, often crash and burn during downturns. Second, they're maintaining significant liquidity. Not because they think cash is a great investment, particularly with inflation still above the Federal Reserve's target, but because cash gives you options. When everyone else is forced to sell during a crash, having liquidity means you can be the buyer. Some of the greatest fortunes in history were built by people who had cash available during moments of maximum fear. Third, they're diversifying more broadly than ever, not just across different stocks, but across different asset classes, geographic regions, and investment strategies. Real estate, both direct ownership and through REITs. Commodities, particularly gold, which has been surging to record highs as investors seek safety. International markets, especially in regions where valuations are more reasonable than in the United States. Alternative investments that don't move in lockstep with traditional stocks and bonds. Fourth, and perhaps most importantly, they're thinking in decades, not days. They know that market corrections are inevitable. They know that bear markets happen. They know that crashes occur. But they also know that over long time horizons, quality investments compound and wealth grows. Their goal isn't to perfectly time the market, because that's impossible. Their goal is to own great assets and be positioned to survive and even benefit from volatility when it arrives. Now, whenever someone starts talking about market crashes, there's always pushback. The market has been expensive before and kept climbing. Predictions of doom have been wrong more often than right. Maybe this time is different. Maybe we're in a new paradigm where old valuation metrics don't apply anymore. There are some factors that make 2026 particularly interesting from a market perspective. It's a midterm election year, and historically, these have presented challenges for markets. Since 1950, the S&P 500 has posted more modest returns during midterm years compared to other years in the political cycle. The uncertainty around policy direction and potential changes in Congress can weigh on investor sentiment. There's also the question of whether we're experiencing an artificial intelligence valuation bubble. To be clear, AI is real and transformative technology with enormous potential. But that doesn't automatically justify every company's AI-related valuation. History shows that genuinely revolutionary technologies, from railroads to the internet, have often created speculative bubbles even while the underlying technology proved transformative. The revolution can be real, while the valuations can still be excessive. The concentration of market gains in technology stocks tied to AI creates a particularly fragile situation. About a third of a broad U.S. stock market index fund is now invested in the Magnificent Seven stocks. If you own a simple S&P 500 index fund, you're extremely tech-heavy whether you realize it or not. This concentration means the market's fate is increasingly tied to whether AI lives up to its extraordinary expectations. Then, there are the real economic crosscurrents to navigate. The labor market, while still strong by historical standards, has shown some signs of cooling. Consumer debt levels remain elevated. The Federal Reserve, while it has begun cutting interest rates from their recent peaks, is moving cautiously, and rates remain above levels that prevailed for much of the past 15 years. Trade policy under the new administration introduces another layer of uncertainty that markets will need to digest. But here's the thing about market crashes that often gets lost in the fear and panic. They're not the end of the world. They're not even necessarily bad for long-term investors. In fact, crashes can be wealth-building opportunities if you're prepared for them. Data from research firms examining nearly a century of market history shows that the average bear market for the S&P 500 has lasted roughly 9 to 10 months. Stock market crashes, which are typically driven by emotion rather than fundamentals, can be even shorter. The COVID crash in 2020, which saw the market lose 34% of its value, happened in just 33 days. Now compare that to bull markets, which historically have been more than 3 times longer than bear markets. The typical pattern on Wall Street is that markets spend considerably more time going up than coming down. Even more telling is research examining rolling 20-year periods going back over a century. Studies have found that the vast majority of 20-year periods, regardless of whether they included depressions, recessions, wars, pandemics, crashes, or any other calamity, delivered positive returns for investors who stayed invested. This doesn't guarantee future results, but it speaks to the resilience of equity markets over long time horizons. This doesn't mean there's never a bad time to invest. If you bought at the peak of a bubble and needed your money back during the crash, you suffered real losses. But if you had the patience and perspective to hold quality investments through the turbulence, history shows you would have been fine. The danger isn't the crash itself. The danger is how you react to it. The biggest mistake investors make during downturns is panic selling. When markets are falling and headlines are screaming crisis, the emotional pull to get out is overwhelming. You watch your account balance shrink day after day, and every instinct tells you to stop the bleeding. But here's what the historical evidence shows. Investors who sold during moments of peak fear often missed the recovery. After various market downturns, predictions of worse outcomes to come have frequently proven wrong, and those who sold based on fear missed subsequent rallies. This pattern has repeated across multiple market cycles. This is why millionaires aren't panicking. They're preparing. There's a crucial difference. Panicking means making emotional decisions based on fear. Preparing means making rational decisions based on assessment of risk and opportunity. So if you're not a millionaire with a team of advisors and access to exclusive investment opportunities, what should you do with all this information? First, resist the temptation to try timing the market. Yes, valuations are elevated. Yes, warning signs are flashing. But predicting exactly when a correction will happen and how severe it will be is nearly impossible. Even the experts get this wrong constantly. Stocks can remain expensive for years before correcting. They can also keep climbing from levels that seem unsustainable. What you can do is make sure you're invested in quality. Look at your portfolio honestly. Are you holding companies with real earnings, sustainable competitive advantages, and strong balance sheets? Or are you chasing momentum, hoping to catch the next big winner, invested in businesses you don't really understand? The companies most likely to survive and thrive through volatility are those with durable business models. They generate consistent free cash flow. They have low levels of debt. They operate in industries with real staying power, not just temporary hype. They're led by experienced management teams who've navigated difficult markets before. Second, maintain adequate liquidity. This doesn't mean selling everything and going to cash. But it does mean having an emergency fund that can cover 3 to 6 months of living expenses in readily accessible accounts. It means not being fully invested to the point where a temporary market downturn would force you to sell at the worst possible time. Cash feels like a waste when markets are soaring. But when markets crash, cash becomes opportunity. The investors who build generational wealth are often those who had the resources available to buy quality assets when everyone else was selling in fear. Third, consider dollar-cost averaging if you're still adding to investments. Instead of trying to invest a lump sum at the perfect moment, spread purchases over time. This way, you buy more shares when prices are low and fewer when they're high. Over long periods, this disciplined approach often beats trying to time entries and exits perfectly. Fourth, think about diversification not just across stocks, but across asset classes. Quality bonds can provide stability and income during equity market turmoil. Real estate, whether through direct ownership or REITs, offers exposure to a different set of economic drivers. Some allocation to gold or other commodities can serve as a hedge during periods when traditional assets struggle. The goal isn't to predict the future. The goal is to build a portfolio resilient enough to handle multiple possible futures. Because the truth is, nobody knows what 2026 will bring. Not the experts, not the millionaires, not the Federal Reserve, not me, and not you. What we do know is this: markets are cyclical. They go up and they go down. Valuations matter over time, even if they can be ignored in the short term. Quality persists when hype fades, and patient investors who make rational decisions based on fundamentals rather than emotions tend to build wealth over decades. The millionaires aren't preparing for a crash because they have some crystal ball that tells them it's coming. They're preparing because preparation is what prudent investors do regardless of market conditions. They stress test portfolios. They maintain liquidity. They focus on quality. They think long-term. These behaviors serve you well whether a crash materializes or not. If markets do correct significantly in the coming months or years, the prepared investor views it as an opportunity, not a catastrophe. Prices falling means the same quality businesses are available at better valuations. Future returns improve when you can invest at lower prices. If markets continue climbing despite elevated valuations, the prepared investor doesn't kick themselves for being cautious. They recognize that discipline and prudence, even when it means missing some upside, is what allows you to stay in the game for the long run. The investors who blow up are never the ones who were too conservative. They're the ones who got too aggressive at the wrong time and couldn't recover. Here's the final thought I want to leave you with. The goal of investing isn't to get rich quick. It's to build wealth steadily over time, to achieve financial security and independence, to create options and opportunities for yourself and the people you care about. That happens through discipline, patience, quality, and perspective. It happens by learning from those who've successfully navigated multiple market cycles. It happens by preparing for difficulty while hoping for prosperity. The millionaires are preparing not because they're pessimistic about the future. They're preparing because they're realistic about markets. They understand that after periods of exceptional gains often come periods of consolidation or decline. They know that trees don't grow to the sky, and that what goes up usually comes down before going back up again. And most importantly, they know that the real money in investing isn't made by perfectly timing every twist and turn. It's made by owning quality assets, staying invested through volatility, and having the courage and resources to buy more when others are selling in fear. So take a look at your own portfolio. Ask yourself the hard questions. Are you positioned for resilience, or are you chasing returns? Do you understand what you own and why you own it? Could you handle a 30 or 40% decline without panicking? Do you have the liquidity to weather a storm or seize an opportunity? These are the questions the wealthy are asking themselves right now. And regardless of whether a crash comes in 2026 or years from now or not at all, they're the questions that separate investors who build lasting wealth from those who don't. If you found this valuable, take a moment to hit that like button. Consider subscribing if you want more content that cuts through the noise and focuses on timeless investing principles. And most importantly, take some time this week to honestly assess where you stand and what adjustments, if any, might make sense for your own situation. The market will do what the market does. Your job is to be ready for whatever comes next.